The dollar will continue to weaken this year as the global economy recovers from recession and investors seek currencies linked to growth, strategists said in a panel on Bloomberg Radio. Rebecca Patterson, global head of foreign exchange at JP Morgan Private Bank in New York, says investors in the US and globally are sitting in too many T-bills and too much cash. She adds that as the world economy slowly improves, they are going to want to take advantage of that. They want a better yield than you get in a T-bill, and that keeps the dollar under pressure. Callum Henderson, global head of currency strategy at Standard Chartered in Singapore, says the dollar has further downside to go. He adds there will be a renewed period of downside for the dollar, but more positively, upside for high-yielding emerging market and developed market currencies. The US dollar may weaken as governments worldwide reduce the currency's role in their foreign exchange reserves, said David Weiss, chief economist at Standard & Poor's. He expects the dollar to be less dominant in world reserves as it has been in the recent past. He explains the dollar will still be the biggest reserve currency but will go back to a more normal distribution like 10 or 15 years ago when the dollar was 70% of reserves instead of 90% of reserves today. Strategists also said China's ability to continue growth will depend on the nation changing from an economy driven by exports to one expanding on domestic demand, which may increase the value of the yuan. The People's Bank of China said today in its 2008 annual report that the yuan's exchange rate will be kept at a reasonable and balanced level. Standard Chartered's Henderson says that Asia is at a tipping point where you'll see a transition from export-led growth to domestic demand growth. The world has already seen the first stage with a huge focus on domestic demand, a huge focus on consumption. He adds that the next stage is surely a move away from a cheap currency policy towards stronger trade-weighted currency appreciation in order to dampen consumer costs. The pound may have to weaken for the UK's economy to recover from a recession, Paribas Radica said. GDP contracted 0.8% in the second quarter from the first, twice as much as economists forecast. Radica adds that it is obvious that the British economy needs substantial contributions from net exports in the next 5 to 10 years, which also means the UK will have to adjust its cost structures drastically or operate with a much cheaper exchange rate.